Good afternoon, everyone. Thank you for joining us today. My name is David, and I work in the research team here at StuRents. Before I hand over to Richard, there's a few bits of housekeeping to take care of. So firstly, this webinar is being run to coincide with the release of our 2025 annual student accommodation report, which will make a copy available to all those on the call in the coming days. I'm also delighted to say we're joined today by leading industry experts who will be continuing the discussion at the end of the data presentation and hopefully answering some of your questions. If you do have any other questions, please submit these via the Q&A function. We'll try and get through as many as we can if we have time. On that note, I would now like to introduce the panel who's joining us today. If I could start with Yanis, can you please give a quick 30-second intro?
Good afternoon, everyone. Yanis Verdelis, Managing Director for Development and Investment here at Landmark Properties. We are the biggest player for student housing in the United States and recent entrants and investors in the UK PBSA market.
Cool, thank you. Anthony, could you go next?
Thanks, David. I'm Anthony Hart. I head up the student housing team at Allsop. For those of you who don't know Allsop, we are a multidisciplinary property consultancy based predominantly in the UK.
Thank you. And then Sky, over to you.
Thanks, David. Hi, everyone. I'm Sky Mapson. I'm a Senior Director in our Development Origination team at Maslow Capital. We are a credit provider on development projects throughout the UK and Europe.
Okay, thank you. Thank you, everyone. We look forward to hearing your opinions and hopefully tackling some questions with you all shortly. Before I hand over to Rich for today's presentation, we'd like to launch a quick poll. So that should be appearing on your screen now. So the first question is, what are your rental growth expectations for 2026, 2027? Second is, what are your expectations for PBSA leasing velocity this year compared to the 2025-2026 academic year or letting cycle? And how has your overall view towards the student accommodation market shifted over the last 3 months? Okay, so yeah, just give a minute to kind of work through those. So we'll receive the output from the poll after the presentation. So yeah, when you're ready, it's now my pleasure to hand over to Richard as well to run through today's presentation and data.
David, much appreciated. We've got a fair amount to cover in 25 minutes, roughly speaking. As kind of David's alluded to, a lot of the data we're going to go through is being pulled from our 2025 annual report. For anyone not familiar with what we do, just as a very quick introduction, so we have 3 distinct arms of the business. We have our listings platform, StuRents.com. That's been going since 2008. And we advertise, roughly speaking, about 750,000 beds across the UK. And that's a mixture of both HMOs as well as private PBSA. We are also a leading provider of property management software to the sector, and that's via our brand called Concurrent. And then essentially from a research standpoint, we can leverage those 2 platforms, supplement that data where we need to provide highly granular insights to a real range of stakeholders within the sector. And obviously, we'll go through some of those insights today. In terms of the topics we'll be covering in roughly 25 minutes, so we're going to have a bit of a recap looking at the latest demand trends. We'll then look at what that has meant for specifically PBSA leasing velocity for the cycle just finished. We'll then kind of shift gears slightly and take a look at the concept of data asymmetry. So start to think about how data can be used, but also how it can be improved within the sector. And then we'll do a bit of crystal ball gazing, looking at the potential outlook for, again, UK student accommodation. After that, as David said, we'll go to the panel discussion and hopefully get a chance to run through some Q&As as well. So we're going to start off with looking at some of the key demand trends. Now, some of this data will be familiar to people, so I won't spend too long on this, but it gives a nice overview of what's happened in the last few years. So starting off with the latest data from UCAS. So this is UCAS acceptance data up to the 2025-26 cycle. And to summarize, really, it looks pretty positive. So we've actually seen acceptance growth across all the key domiciles, so UK, EU, and non-EU, all increasing year on year, which is really positive to see. Having said that, though, we do know there has been some anecdotal increases in the number of students deciding to live at home, and that's a topic we'll explore in more detail shortly. Equally, UCAS have released relatively recently their data covering the October deadline, and that goes up to the 2026 period. It only represents, I believe, about 10–15% of applicants. But again, that data is looking positive, and the numbers are up about 7.4% from an applicant standpoint. So as I say, from an undergraduate perspective, the trends are looking good. As I say, that is, though, somewhat being offset by a rise in the number of students deciding to commute or to live at home. So on that, we wanted to kind of explore that affordability question in a bit more detail. Now, a lot of stakeholders within the market talk about affordability and specifically talk about it in reference to the maximum student loan. Now, in our opinion, that's probably not the best way of doing it. And actually, what's quite interesting, because the maintenance loan is means tested, if you are a prospective student, for example, coming from a household with one parent earning just above the minimum wage, you will not receive that maximum. So actually using the maximum maintenance loan as a benchmark is not reflective of the masses. Now, in this particular data set, what we've essentially done is we've said, take a student coming from a household income of £40,000 per year. So it's not significant. You could have two parents earning essentially just above the minimum wage. And what does that impact do to your maintenance loan after the cost of accommodation has been taken away? Now, as you can see, there are an increasing number of regions, so London, the Northeast, Southeast England, and Southwest, where on that basis, the maintenance loan does not even cover the cost of accommodation. In our calculations, we've blended the cost of HMOs and private PBSA to give a more rounded view, but that is a trend we have seen increasing. And actually, if we look at that same data set from last year, the number of regions has gone up. So that is worth bearing in mind, and that does partly explain why we are seeing more domestic students deciding to live at home. So it's very pertinent. It's a topic that's clearly not going away, but when you start to look at those numbers on an adjusted basis in terms of family income, it becomes quite stark. Moving on, one other key question that we have received a lot of interest, particularly in recent months, is trying to understand what has happened more recently from a total student perspective. Now, one of the data sets that we can leverage to help guide this is data from the Office for Students. Now, what the chart on the right is depicting is the change in the number of undergraduates or the number of postgraduates, either reflected from HESA, which are the two solid lines, so solid navy line or solid orange line. And essentially, we've overlaid that with the Office for Students data, which are the dashed lines. Now, the reason why this gets quite interesting is, as we know, HESA has a huge time lag, only goes up to 2023. The OFS, whilst it is out of date, it is more recent and does go up to 2024. What you can also see from the lines is the two data sets are highly correlated. So it starts to give a more up-to-date view in terms of what has happened to those undergrads and postgrad numbers. There are some technical differences, which we won't necessarily go into today, but as you can see, it does give a good indication. And if we focus on the dashed navy line, which is the OFS data, depicting the change in full-time postgraduates, we can see that in 2024, that declined by about 13% year on year. So we would expect the HESA data, when it's released early next year, to show a decline in those postgrads. Positively, undergrad numbers, as we kind of alluded to from the UCAS data, is still going in the right direction, and it is still increasing. On top of that, we know anecdotally that for the 2025 season, there has been some universities that decided to adjust their entry grade requirements, for example, and they wouldn't really be doing that, particularly if international postgrad demand was there. So that does suggest there may have been a further fall in those postgrad numbers. Having said that, something that is worth bearing in mind as well is that those postgrad numbers have come off from a very high post-COVID base. So it's something that's worth bearing in mind. So if we take those two data sets, and on the basis that undergraduate numbers have likely grown since 2023, but postgrad numbers have likely fallen during that same period, we can then quite simply run some modeling to try and understand what has happened to the total number of students in the UK. Now, this particular chart is leveraging the data from HESA. That data, as we alluded to, only goes up to 2023. But on that basis, if we apply those two trends, what we are estimating is that in 2024 and in 2025, the total number of students has likely declined. And again, that's because the postgrad number is dragging down the total. Further data that actually was released today, so it's very up to date, is latest visa data. Now, that data set actually splits it down by specific countries of origin, and we can see China and India in this particular case. And if we focus on the far right-hand side of that chart, we can see the Q3 number literally released today, and that shows about a 12% decline in the number of visas issued to Chinese students in Q3 just gone. India, surprisingly, actually was up year on year, which may have surprised some. But that also ties into, I guess, the more challenging environment that we've seen the last year in particular, and again supports that view that postgrad numbers have likely continued to decline. So we've kind of looked at those headline demand trends. What we then wanted to explore is what does that mean from a supply and demand perspective? Now, this particular chart is looking at supply and demand nationally outside of London. For anyone not familiar with how we look at supply and demand, typically, we don't run student-to-bed ratios, which we'll come back to shortly. But what the chart is depicting is the change in demand over time, and that's represented by the navy line, and we have a dashed line there because, again, we are estimating what demand has likely, or how demand has likely changed since 2023, and the orange line is the change in supply. Now, a couple of things that's worth noting from that analysis is that when that spread was at its largest, so 2022, for example, that's when we were seeing very strong leasing velocity and double-digit rental growth. Now, again, if we assume that total student demand has actually come off the last few years, it means that gap has significantly narrowed. And again, that correlates to a slower leasing environment, but also a lower rental growth environment as well. So again, this is typically how we're looking at supply and demand, and we'll take a look at a particular example from a city level in a minute. So what does this narrowing in the spread in terms of supply and demand mean for leasing velocity? Again, for anyone not familiar, we are capturing leasing velocity every single month across about 180,000 PBSA beds. And that allows us to give a pretty up-to-date view on market performance. Now, we've aggregated this data just to give a high-level overview, and we've plotted that across a number of years. The orange line, which is the 2025 cycle just gone, we can see it was both slower and it was lower in the end as well. So again, that's really reflective of those tougher market conditions. What you can actually see from the orange line, though, that is worth noting is whilst the market was down, there definitely was a change in booking behaviour from students. And you can see, particularly around the August and September time, a bit of a bump up in that line. And that does suggest that students have been delaying their accommodation choices. That's also reflected in our own booking data as well. We see it in the platform with, again, certain demographics deciding to book much later in the cycle. To give you some numbers on this, so if we look at the September figure, again, aggregated across all the data that we track, it was about 86% occupied, and that's down from 91% in the previous year. And we are, in the coming days, about to release the October data set as well. As always, though, there are huge variations per city, and this particular chart, we've taken half a dozen unnamed cities, but really just to highlight the spread in performance at a locational level. So if we were to take City 1, which is the orange line, versus City 6 in this case, which is the navy line, and for example, look at April earlier this year, there's a 26 percentage points difference in leasing velocity or occupancy at that time. So again, a significant spread in performance per location. Equally, if we look at the figures in September, again, that spread, whilst in some cases narrowed, in terms of location versus location, it was still pretty significant. On top of that, we are starting to see some interesting localized trends. Glasgow is a good example of this. We have specific regions in the city outperforming perhaps others. So again, this is giving a good high-level overview, but the micro-location will be very important as well. So we've covered some of the kind of key stats around supply and demand and occupancy, and really wanted to then leverage that data to kind of highlight how we can start to use that to identify opportunities and risks. But we also wanted to use that as opportunity to essentially critically assess how the market has historically looked at supply and demand. As I mentioned earlier, typically we are not reporting on metrics such as the student bed ratio or headroom analysis. Now, in this particular example, we have focused on Nottingham. One of the reasons for that, I think anyone within that city will have experienced tougher market conditions. And that's really reflected in that same supply and demand analysis we saw a few moments ago from a national perspective. To interpret the chart or to read the chart very quickly, again, the navy blue line is growth in demand, the orange line is growth in supply. Again, from a demand perspective, we don't know for sure what happened after 2023, hence we have a few different dashed lines there showing different growth scenarios. But really what you can see is between the period 2016 and 2022, demand growth, as I say, was outstripping supply growth. And that's going to be supportive of occupancy and supportive of rental growth. The challenge in somewhere like Nottingham is that supply growth has been fairly substantial, and that has coincided with a period where demand has likely declined. And we can see that those market conditions have therefore flipped, and that is then reflected in the occupancy rate. So we can see September occupancy falling from about 97% in 2022, when again demand growth has been higher than supply, to less than 80% for the 25 cycle. So again, there seems to be a good correlation between this kind of fundamental analysis and what we're seeing from a occupancy and therefore rental perspective as well. To give some added context to this, if you were to run a student bed ratio or headroom analysis in Nottingham, it would still show a very undersupplied market. So 1.8 students for every PBSA bed, for example, or headroom of about 25,000 beds. So depending on your access to data, whether that's a legacy metric like the ratio or analysis that we typically run, you could have very different opinions on that market. And that naturally creates this dynamic in the market where those that have access to high quality data can potentially have better insight and therefore can make more informed decisions, but also can potentially spot opportunities as well ahead of the competition. I think just lastly on, again, some of those legacy metrics, I think we only have to look at places like Coventry or places like Sheffield, where clearly that metric such as the student bed ratio has been proven not to be accurate given the conditions and how that market has performed. So we've kind of critically assessed some of the metrics within the market. We wanted to then look at how can we leverage unique data sets to actually identify opportunities. Now, this particular chart is focusing on age of stock. And again, there are some very big differences. So if we were to look at Leeds, for example, we're looking at more than 30% of PBSA beds there have been delivered since 2020. Whereas at the opposite end of the scale, Cardiff is an example, but if we take Liverpool, less than 10%. So it does mean there's a big difference in age of stock per location. Obviously, that's going to somewhat be reflected also in things like amenities. And it does mean there may be some isolated opportunities, take Liverpool as an example, where actually newer accommodation that is perhaps of a good quality and a high spec doesn't have much competition in terms of that same level of quality. Whereas in somewhere like Leeds, that's potentially going to be much tougher given the age of stock there. Equally, we are seeing increased appetite to look at value add opportunities or refurbishment opportunities, which I think is an interesting angle. I think that's certainly one we would expect more and more parties to be interested in. But I would just be aware of what the intended end user is of that. So there are certainly PBSA products or assets in the market that, for example, are of a lower rental value, but that makes them attractive to the domestic market, for example. So a refurbished program might then take that rent outside of that affordability range for the domestic student So again, you could see a situation where the intended end user of that product does change, and that's again something that's worth bearing in mind. Looking at HMO and PBSA next, and we'll come on to the Renters' Rights Act shortly, but certainly there are going to be some locations where there's an existing overlap between demand for HMOs, and this particular chart is showing demand by price for HMOs, versus the existing PBSA supply in that same market. So in these particular examples, we could find a situation where more affordable PBSA, again, particularly in the light of the Renters' Rights Act, might find it easier to attract domestic students out of the HMO market if that price spread is reasonable. So that's something that's worth bearing in mind. Again, that spread will vary significantly per location. But going forward, I mean, in most locations, British students do represent the largest demand pool. So it certainly is a very large target market if you have a product that is adequately or correctly priced, as well as positioned as well. So as I kind of mentioned, we wanted to then look at the outlook for the sector and actually start with the Renters' Rights Act. Now, I think what's worth noting, there has been a lot of dialogue and commentary around the Act more broadly, but the one point we wanted to focus on is the potential impact for 1 and 2 beds. So something that may be less obvious to those on the call or those looking at the impact is that whilst PBSA is broadly exempt, HMOs do benefit from grounds 4A, which means the landlord can take repossession of their property in line with the new letting cycle. But actually you have 3 tiers, because we have the situation where 1 and 2 beds, whilst technically not HMOs, are being let to students, but cannot benefit from grounds 4A. So landlords of those 2 particular property types have no certainty in being able to take repossession of that property in line with the letting cycle. Now, where it starts to get quite interesting is in some markets, we have seen 1 and 2 beds increase because domestic demand has increased. And obviously there are restrictions around delivering more HMOs. And if we take the example of Nottingham, you're looking about 20%. So about 20% of PRS properties being let to students in Nottingham are 1 and 2 beds. And that immediately raises the question of what happens to that supply if landlords cannot ensure they can let their property in line with the letting cycle. So again, we actually are moving to a 3-tiered market, which is going to be interesting to see how that plays out. Looking ahead and going back to the UCAS data, just specifically looking at countries of origin, I think positively, again, all the demand data sets are looking pretty positive. Chinese demand is up significantly year on year in 2025. As I mentioned previously as well, the latest data for the 2026 early October deadline data also points to continued growth. So again, undergraduate demand is still looking very positive. As we know, particularly in the PBSA market, there is possibly an over-reliance on that Chinese demand. But again, undergraduate demand looks pretty good. From a planning perspective, this particular chart is looking at the number of beds either submitted or approved on a rolling 12-month basis, so we can quite easily understand the levels of activity. And we can see that after a bit of an increase in previous years, that has come off pretty significantly. And actually year to date, you're looking at, roughly speaking, about 30% decline in beds being submitted. And that's going to be supportive in the kind of medium term with regards to limited supply growth. On top of that, we've done quite a lot of analysis on an increasing number of locations, looking at the likely delivery rate of those beds that have been submitted and approved. And the number has been coming off, but actually it can be as low as 20 or 30% of the pipeline actually reaches practical completion. So again, there are some markets where we do see significant pipelines, but in reality, clearly only a very small fraction of those are actually likely to be delivered. In terms of the delivery of new beds for 2025 just finished, we were looking at about 17,000 new PBSA beds added. Again, that's relatively low from a historical standpoint. And as I mentioned, with planning activity continuing to decline, we would expect those delivery numbers to remain, again, relatively low from a historical standpoint. So to finish, we just wanted to then bring it right back to the original chart, or one of the original charts that we ran through, looking at supply and demand at a national perspective, and just kind of somewhat do a bit of crystal ball gazing in terms of what that market might look like going forward. So again, we've got this dashed line. I think positively here, this analysis is based on 2% demand growth per year. So 2% demand growth in 26, 27, et cetera, which is not significant. But actually, on that basis, we would see that spread between demand growth and supply growth start to improve again. So I guess the point here is that the market can move quite quickly, and we've seen that over the last couple of years. But equally, it wouldn't take much from a demand growth perspective for, again, that spread to start to increase again. And that's obviously going to drive, hopefully, improved occupancy and improved rental growth as well. Having said that, as we mentioned with regards to the occupancy data earlier, every market is very different. So knowing your individual markets at a micro level is going to be absolutely fundamental going forward, but also so is market timing. So again, if we refer back to the example of Nottingham, those markets that have seen perhaps a shift in dynamics, having foresight of when that might happen is going to help stakeholders understand whether the timing is correct or not, either to enter or exit a market as well. So to summarise, before we move on to the panel discussion, as I say, undergraduate demand still looks pretty healthy, albeit do be aware of that increasing proportion that are living at home. But we do believe that has been offset by declines in the number of postgrads. 2025, from a PBSA leasing standpoint, was definitely slower and also lower. And that has been reflected in the rental growth for PBSA, which for 2025 was broadly flat year on year. As I say, there are going to be isolated opportunities, but stakeholders have to be a lot more selective than perhaps they have been historically. And that could be looking at micro-location, could be looking at age of stock, for example. So again, it's worth bearing in mind. And as I've just mentioned, fundamentals can quickly shift. And we've seen that in the last few years, both nationally and at the city level. So again, that is worth bearing in mind. As David mentioned ahead of the presentation, we are going to make sure that everyone on the call receives a copy of our 2025 annual report. Equally, for those that are interested in receiving our monthly newsletter, you can scan the QR code and sign up there, or just head to StuRents.com/research to sign up to that same newsletter. So there's a lot to cover. As I say, we're only really scratching the surface of what we're going to provide in our annual report, which should be released in the coming days. But hopefully there's a lot of context there and a lot of content to have a kind of really meaningful discussion over the next kind of 25, 30 minutes or so. So I will stop showing my screen and I'll hand it back to you, David, and we can possibly go through the poll results and then crack on with the panel discussion.
Sure. Thank you, Richard.
So let me just launch the poll results.
All right. Okay. So for the first question, rental growth expectations for 2026, 2027, we've got quite a lot of responses in the kind of mid-range, the 1 to 2 and the 3 to 4%. Only a small number in the 5+%, so it's a bit more reserved expectation there. Expectations for PBSA leasing velocity this year compared to 25, 26. Kind of in the middle again, so neutral, although some optimism with a decent portion on the up. For the third question, how's your overall view towards the student accommodation market shifted over the last 3 months? So interesting that over half have responded more pessimistic. So we'll see how that plays out in the coming months. Right, I think we can now move to the panel questions and open up for kind of general discussion. So what I'm going to start off with, this is for kind of everyone. We somewhat covered it during the presentation, but what do you feel are the main contributing factors impacting the leasing velocity for 2025? Do you see any other interesting aspects such as variability? Yeah,
I'm happy to start and then keen to hear everyone's views. So I think the few elements that we probably didn't cover in tons of detail are they say, live at home rates, we do know that has increased. Obviously, it would be amiss for us not to talk about things like BTR and co-living. Obviously, that is going to be very city specific. Obviously, Leeds is the case study that everyone has been talking about the last few years. So I think from my perspective, it's been a combination of demand likely to have declined, again, because of postgrad numbers. You've got an increasing number of students living at home. And then we have in some cities, increasing competition from other accommodation types. So I think it's not one factor, it's a combination of all those factors. And again, that will vary per city for sure.
I would sort of echo that. I think it's I don't think there's one sort of discrete reason you can point to in terms of the cause. I think there's vast differences between cities and then even within cities. Rich references Glasgow. Glasgow is a really good example of that. I know some people who are full and have absolutely flown in terms of rental growth, and I know people who are 60% full. So I think the frustrating thing is not being able to sort of specifically point to what it is. Some markets just have huge pipelines and there's competing asset types that sort of take students away. Others are just suffering from that more general supply-demand dynamic. I think it's a wide variety of reasons.
Okay, thanks, Sky. Anthony, Yanis, I don't know if you've got anything you want to add there.
The only addition that
sorry, Yanis. Yeah, start with you.
No problem. The only addition we haven't talked about, there are some global economic and political changes that are happening, right, from key markets that have been key sources of demand for the UK and China, for example, and how that economy is actually doing. And the geopolitics. I think the UK has become a much more welcoming country for international students over the last couple of years, certainly over the last 1 year. Other markets that are competing for the same international cohorts, the US, Canada, and Australia have gone the other way. We know from when that was in reverse that it takes 2 to 3 years for the effects of that to be felt in demand. Students don't decide where to go just 6 months out, whether to go to the US or the UK or Australia, but they start thinking about that type of stuff 2 years before graduating from high school. So there is maybe some tailwinds, hopefully, for the UK market as the effects of recent developments in the US and the more welcoming approach of the UK are felt.
Thank you.
That's well covered, David. Yeah, the only thing I would say is that I'm seeing quite a lot of schemes which feel pricing out of sync with perhaps quality, and this wave of rental growth that we've all benefited from as a sector, perhaps much more nuanced now, and perhaps some schemes got caught out whereby perhaps they weren't justifying the sort of rental growth that we saw in the past year or so, and therefore students have gone, well, that doesn't look like good value for money to me anymore, and that would be my only addition to everything that's been said.
I think adding to that, I mean, the rental growth is an interesting point, and I think again you look at the historical, is close to probably 2-3%. So certainly those assets that saw, again, in some cases 15% plus in a single year, that's rental growth that in a normal situation or normal market would have taken many years to achieve that same rental growth. So that shock of a significant increase in 1 and potentially 2 consecutive years definitely would have influenced certain students' decisions for sure.
Great, thank you, Richard. And moving to you, Anthony, specifically. So for Allsop, you've obviously got transactional experience across both PBSA and HMO. What trends are you seeing with HMOs, with potentially increased appetites to sell from landlords given the Renters' Right Act, or are you kind of seeing the opposite?
Okay, that's a big question.
An easy one for you. There you go.
I'd say if we just focus on HMOs, would say that there's been some increasing levels of engagement from traditional HMO landlords with us in respect of potential sales. But I do think it's important to caveat that point by saying that these people aren't generally forced sellers. It's not that they are financially, they're not financial reasons necessarily that they need to sell. And it's not just the Rentals' Rights Act either influencing sort of decision making. there's a whole host of factors driving this. And for some, it's purely a timing point. And you think about traditional HMO landlords, they may have started building HMO portfolios 25, 30 years ago. Well, for them, it's assessing succession plans and sales potentially to pave the way for retirement. So I think there's a lot to consider here. And it's also probably true that many of those traditional landlords are thinking, well, this environment isn't what it was. There's probably 4 or 5 increasingly prominent national aggregators increasing and improving and pushing boundaries and standards across the UK in the HMO space. And then there's this sort of more regulation, planning, policy, tax, space and amenity standards, increased cost of debt for some. When you put all that together and then you sort of add, the fact that they've carved PBSA out of the renters' rights and not HMOs, maybe the mentality is, let someone else have their go now. And to answer your question, David, we are seeing increasing levels of engagement from HMO landlords, but it's not just driven primarily from the renters' rights, or I think it's a culmination of factors, and one of the main points is timing.
Okay, thank you. I don't know if anyone else had anything that they wanted to add on that one specifically.
Yeah, I think the only thing I'd probably add to that, and we also ran a survey relatively recently with over 1,000 students, and probably not a surprise, but specifically regarding the Renters' Rights Act, a significant proportion have not even heard of it. So, probably separate from what Ant was describing, it will have an impact, but I think there are still big questions over to what degree and when, and that's probably still debatable, to be perfectly honest. So yeah, I think there's still certainly a lack of awareness, specifically around the student side, and it may take a good couple of years at least for that to then really flow through to landlords deciding to sell up if that's the decision they make.
Thanks, Rich. Sky, moving on to Maslow Capital. So Maslow's been quite active in recent years. What is it that you find attractive about UK student accommodation over other asset types? And do you see further opportunities in the UK or is more towards continental Europe?
So Maslow is a living sector development lender. So PBSA has always been a part of what we did. And we've been doing it for sort of 13-ish years. So we've always liked the asset class. And as we become more familiar with it, you get to know people in the space. It becomes slightly more formulaic, for want of a better word, in terms of who you back, how you back them, and where you go. So we sort of have a relatively deep understanding of the sector, so that's why we like it. I think over the past 3 years, what you've seen is, given sort of ongoing viability challenges in the resi space, a lot of people have had to pivot into PBSA. And I'm not saying that's necessarily a right thing, but you get the density that makes a scheme viable that you might not necessarily get on a resi scheme. So I think, particularly in London, say, our activity in London has largely been driven by resi developers pivoting into student accommodation. So that is also something that's relevant. In terms of sort of going forward and future opportunities, Rich has kind of mentioned it, but I think buying existing assets at below replacement cost, refurbishing those, rebasing the rents to an appropriate level is an interesting strategy. I also think Europe is super interesting, right? A lot of European locations are like some of the UK's sort of 10, 15 years ago. And there is a vast opportunity there for the right people. And it's something in the fullness of time that we will do more of.
Okay, thank you. Just following up generally, so how has your offering changed in the face of, say, Building Safety Act and other regulations?
Yeah, the Building Safety Act was initially a real headache. We have had to seriously adapt to how we think about that. I've seen schemes take a year to go through that process, which is fine. But what we have done in sort of response to that is develop developed our product offering slightly. So we'll gear on the land, we'll provide a small capex loan to help people fund the costs to go through the gateway process, and then we pre-commit to the development loan once they're through it. I mean, one of the observations that I've had is, and I don't know how the other guys feel about it, the BSA is obviously incredibly well intentioned and is the right thing. And you could talk about your frustrations around what that's done to delivery, etc. The sort of flip side of that is, well, actually, it's created a bit of a barrier to entry. You have to be very well capitalized, you have to be bankable, and you have to be willing to go through that time pain, and it requires a great deal of resource. So you are not, every man and his dog isn't going to be able to go through that. So it's actually from a supply side perspective, and again, it talks to some of the slides Rich had around delivery and pipeline and the percentage that is ultimately delivered. I think that will only diminish in the medium term.
Okay, thank you. Kind of following up again on that for Yanis, specifically, do you see the increased planning regulations as positives?
It's a very controversial question. We believe at Landmark, we've seen from having developed loads of these in the States, barriers to entry generally, markets with barriers to entry is where we have made the best returns. Barriers to entry could be a variety of things. Some markets have lack of available land for development. Other markets have planning headwinds. Other markets have, as it is in the UK, it takes a long time and a lot of money to go through gateway and planning, etc. So we are patient in our investment. We're not quick sort of in and out investors. We develop to own for a long time, and therefore we think that the current conditions in the UK, because we're patient, means that we're developing in a market that will have less supply coming forward than it has done, and over time that will improve the performance of our assets. And for what it's worth, I saw the graph from Richard earlier, which shows kind of supply tapering. We think it will taper more than that because there is a big drop in sort of planning applications going in, but of those that are coming out, we think the percentage that will actually be delivered will be lower. A lot of the planning applications going in right now is people trying to get something so they can trade the land rather than actually having intents to develop, in our opinion.
Yeah, I think on that point, Yanis, I mean, certainly when you look at that completion rate in terms of planning to practical completion, I agree. There is an arbitrary nature of when you or how you analyze that and what cutoff you use, but certainly you've seen that decline over time. So yeah, I don't disagree. I think you will see that percentage again at the moment as low as 20% in some locations, could fall even further.
Thank you. Anthony, coming back to you, on the point of kind of viability challenges for new builds, and whether that's with regulations, affordability, etc. Are you seeing more targeting towards like value add opportunities given these difficulties in that area?
Yeah, definitely. And I think as like colleagues across the sector has been well versed, really, I think we've all been pretty consistent in our view that in our day job, and our experience has been that sort of the last 18 months has been the value add has come to the fore. But this has been happening for quite some time. There've been some, I don't want to name names, but there's been investors looking at and targeting first gen value add opportunities for quite some time. We're only just really though seeing the sort of point in time where these refurbished products are re-entering the market for sale, and it seems like the liquidity for that's pretty good because there's this we talk about affordability. I mean, I can't think of how many conferences have been and spoken and heard about affordability and never heard an answer to it. I guess that this is it, potentially, this sort of mid-market refurbished PBSA. And it does feel like that's created some liquidity for these refurbished assets, which is making this viable. But I've also seen, or we as a team has also seen lots of opportunities on the face of it look like they present value-add opportunities, but Rich touched on it earlier. They don't always work, and it's not so straightforward, and perhaps it's not as easy and as cost effective as some people think. Some of these buildings from an M&E perspective, and you think about, energy and performance, and it's sort of like, it can be costly. So this isn't a simple fix, and it's not, but yeah, the answer to your question, David, is it's the in vogue, if you will, PBSA at the moment is value add. If someone gave me lots of nice value add stuff to sell, I'd do very well at the moment.
Can I ask Anthony, and how do you feel about the depth of the investment market for that kind of product relative to like the shiny new stuff? Like, is there a difference?
Yeah, so I mean, again, I can't go into too much detail, but we're in a sort of beneficial position at the moment of dealing with some assets that have gone through that recycle program, and we've been successful, I suppose, in generating interest in those assets for some, well-established household names in the sector. So, like, you've got to do it well, and you can't cut corners. But if you deliver a good product, we're seeing that the appetite is there, Sky, which, that's encouraging.
Thank you both. I'm going to switch topics, just come back around to an earlier point that we had on the UK being positive towards international students, as a comment from Yanis. So we had a question come in which indicated, that there's new regulations on dependent visas, levy on international students. So, yeah, Yanis, can you just elaborate a bit more on how you see, the UK being positive to international students, given some of those challenges which are kind of being introduced recently?
Yeah, I think to qualify, there has been regulatory headwinds in some of those things. People can only stay for 18 months now. They used to be able to do for 2 years. So there's been kind of a tightening of some regulations. The narrative, the political narrative, is more welcoming. You don't have senior government heads of state, secretaries of state talking against international students. Some of these things a couple of years ago got a lot of traction in international social media and created some nervousness with international students. And if you compare, what's happening right now with students getting arrested in the middle of Harvard campus and getting deported on the spot for having a parking ticket, that's not the environment that the UK is currently projecting outwards. Yes, there is tightening of visa restrictions. Yes, there is extra costs and so on. I'm not saying by any chance that it couldn't be better, but on a comparative basis with some of our big competing markets, it's certainly feeling more welcoming. If you were, if I was a parent in China thinking I want my kids to get English-speaking international education, where do they go? It feels that they'll be more welcome here than they will be in some other markets at the moment.
Thank you.
I think, David, just adding to that, because I appreciate it's very timely and it may have been missed. So obviously the international levy was being proposed pre-budget. I think at 6%, and actually they announced yesterday it's just going to be a flat fee of potentially £925. So yes, whilst it is arguably a barrier to some degree, it's certainly come down in what that value potentially could be. I think it's only out for consultation anyway, so it's not fully confirmed yet, but it's one to watch for sure.
Thank you. Just going to switch on to a couple of the submitted questions that we've had. So the first one is with the merger between University of Kent and Greenwich University to form the UK's first super university. So kind of, can we go through a little bit on what that truly means, whether it's something we'll see happen, more widely across the UK now?
Yeah, I think, look, without going into loads of detail, I think the broader question is there would be no surprises if we saw more of this. I think, again, university finance has been well covered, and obviously the challenges there. I think, off the top of my head, from a Russell Group University standpoint, I think they recently mentioned that they lose about £3,500 per domestic student that they teach. So certainly those challenges are there. So yeah, from my perspective, there'll be no surprise if we saw similar situations happening elsewhere. What that does to underlying demand in those universities is probably a bigger question, which I probably don't have an answer to today necessarily.
Yeah, I completely agree with that. I think it'll become a theme I think if you think about sort of lower tariff or even some medium tariff universities, I think where they sort of they will really feel sort of a move in international demand or so on. I think you're going to see more of that sort of merging just to maintain solvency. Question mark around whether we should really have so many institutions in the first place, frankly, but that's another point in itself. I think the way I think about that, and certainly when we discuss it internally, it's very much as a business we will lean towards London and higher tariff universities that are sort of more financially solvent. So that's just something we've done for years. But yeah, I think it will become a thing.
If you refer to this post-16 education skills white paper the government released, the Labour government are clearly quite, I would say, advocates of. They use the word efficiency a lot, and I think what that means is, potentially encouraging this sort of like coming together of efficiencies with combining at universities, particularly in research and such like. So I think the political backdrop would encourage this. So I have spoken with lawyers, etc., who work mostly with universities, and it does feel like this is something that we could see time and time again.
It will happen more of. The question is whether what form it will take. We've had the University of Manchester is one of the top universities in the country. It's a merger of two that happened some 20 years ago, and since then it's gone from strength to strength because that was coupled with some new investment and their ability to sort of play as a bigger player in a global market. This is very different than Greenwich and Kent. Remains to be seen whether some of these mergers could actually give some of these universities the opportunity to grow in scale and therefore rankings, be better at student recruitment, provide better quality courses, etc. Or whether it is just a measure of 2 weeks and they stay weeks. So there will be more of them. Jury's out what it actually means when it happens.
Yep.
Okay. Thank you all. So before we wrap up, I just thought I'd want to hear from each of the panelists on where you see the biggest opportunities in the next kind of 1 to 5 years. Not necessarily specific cities, but is it UK? Is it Europe? Other places? Is it affordable PBSA, premium PBSA, HMOs, etc.? So, just thinking we could kind of run through and just get some quick thoughts to close out the session.
I'm happy to go first.
Yeah.
I think that there will be multiple opportunities. I think it will come down to the detail, obviously. I guess kind of going back to what Anne mentioned earlier and something we touched on. I think, yes, there's a lot of focus on the affordability side and affordable PBSA. I do generally think that is an opportunity, but it is going to be hyper-specific to individual cities. So again, there are going to be some markets where, as we kind of presented earlier, the spread between medium priced, maybe high-end HMOs to existing PBSA stock is zero or even negative in some cases. So I think there's certainly an opportunity to tap into that domestic demand pool. The counter to that is obviously that's somewhat relying on a continued shrinkage in HMO supply, post renters' rights and other legislation. So it's not guaranteed, but I think that's certainly an opportunity. I think the only other consideration there, though, is that for those that are looking at that, is making sure that they actually have adequate marketing strategies to go after that specific demographic. So a good example is something we touch on the annual report, but we've been talking about this for a number of years, is if you are a PBSA operator or investor that wants to go after domestic students, you should have, ideally, your rents live October 1st. I don't think any PBSA does that. Yes, they may have rebooker campaigns, but public rents are generally not set probably till mid-November at the earliest. So again, it's just understanding the differences in seasonality, who your intended users are, and what does that mean from an operational standpoint to make sure you can adequately capture that opportunity. So that's kind of another consideration people should bear in mind.
I'll go next. I'm going to answer it slightly differently, if that's okay. I think there's probably opportunities in all of those areas or geographies that you referenced. I think those that will capitalize on them best will be, I think there's a lot to be said about brand. Like, if I think about developers with vertically integrated operation platforms, or who have really strong links into, say, the right geographies like China or so on, right? They are the brands or the developers or the sponsors who do the best. So I don't really think it's about, is it the UK versus Europe? Is it the shiny new thing versus the more affordable refurb? I really think it's about your experience in the space. If you have the right kind of brand, if you can drive an operating platform in the right way, and then you can really capture that value. That for me is where the opportunity is.
Thank you. It's an interesting perspective, definitely. It's got a different way of looking at it. Anthony?
Yeah, as it relates to PBSA, then I would just say I would echo what everyone said in the sense that the mid-market stuff, but I think also the sort of I don't know, the best-in-class model too works. It has a place in some markets. I think micro-location now in both of those instances are absolutely critical. But I'll extend it a little bit and I'll talk just briefly about HMOs. I've actually written an article for the annual report that's going to be released post, I think, next week for StuRents, and it sort of covers sort of what the HMO landscape, I suppose, looks like going forward. And what I would say is that, over a sort of 1 to 5 year horizon, I can see that looking very different, and I would back the chimney pots to remain very well occupied in that time, and maybe see some steady rental growth as well. So in terms of opportunity, I see that market. I think it becomes more concentrated in prime areas owned by fewer national aggregators that are improving the quality of the product. And with that, I think comes some strong capital value and rental growth. So, everyone's talking about Brookfield's entrance into the sector. It's super interesting, that move. And there's no surprise to us that's happened. So, HMOs.
Thank you. Yanis, I don't know if you've got any kind of closing comments.
No, for me, for us, I think for the next 2 to 5 years, extremely strong micro locations, extremely good markets, places where we need to remember that some of the other uses, offices, etc., are still struggling more than PBSA. So being able to go into places that over the medium to long term, they will be very difficult or impossible to unlock for student housing. And you were focusing on the strong universities, because we back ultimately the UK higher education infrastructure being one of the best in the world. So that's and one of the most liquid and institutional markets.
Wonderful. Thank you. So thank you, everyone. I think that kind of wraps up the discussion, the panel discussion, and the questions. So yeah, just to kind of close out then. Thank you, everyone, for your comments. I think we've dealt with with quite a broad spectrum of topics and questions. For any outstanding questions, we'll try and cover these in other material we produce, or some have been answered in the chat, and you're always happy to reach out to us directly, or we'll be in touch with answers. It just leaves me to say another big thank you to Rich, Sky, Anthony, and Yanis. All of your comments, discussions, insights, and thank you to all of the attendees for joining the call. We really hope to see you again soon. So enjoy the rest of your afternoon. Thank you.